If you've ever been tempted by a trade that promises a 96% win rate and a $24,000 return in 2 months, this video is for you. Recently, Steve Ganz shared a strategy he calls the flyagonal, a combination of a call butterfly and a put diagonal. And on paper, it sounds brilliant. The call fly profits if the market drifts higher and volatility drops. The put diagonal is designed to make money if the market falls and volatility spikes. Put them together, and you've got something that, in theory, self adjusts to whatever the market throws at it. But I had one big question. Does it really work like that in the real world? Today, I'm going to build the trade exactly as Steve described, test it in a live market history, and see what happens in different environments. Not just the bullish stretch we've had recently, but in grind down markets and crashes and volatility spikes. So we're going to talk about what the flyagonal is supposed to do, why weighted vega changes the game compared to the way it's explained, and how it actually performs when the market moves more than 100 points against you. And by the end of this video, you'll know not just the upside, but the risks and limitations, so you can decide for yourself if this strategy deserves a spot in your playbook. So let's jump in. Today I'm going to talk about this trade from Steve Ganz, and it's called the flyagonal. And you can see that the video here is the flyagonal option strategy, 96% win rate and $24,000 in 2 months on theta profits. So I'm going to take a deeper look into this trade. So first I need to kind of figure out what the rules are. Let's go here. So what it's going to kind of look like kind of gives you an idea on the risk graph. Basically, he's taking a call butterfly and combining it with a diagonal, a put diagonal. So you can watch this video to get the details, but I'm just going to try to kind of throw the rules together real quick. So let's start with that. So basically, what he talked about was a call fly, and he's talking about doing it, let's say 8 to 10 DTE. But I'll get into the details on the strikes. And then he's got a diagonal, and he's got the short put at 8 to 10 DTE and about minus 3% down from the current market price. And then he's got the long put at double that, so 16 to 20 DTE. And basically what he says is that the call fly, it's a butterfly, so you're going to, if it's got negative vega, so if the market goes up and the volatility drops, this call fly should make money. And on the diagonal, if the volatility increases and the market drops, that the diagonal should make money or should increase in the tent size. And we can take a look at that right now as to how he explains that.
How a tent in a time spread can change. Again, we want that change. That's what makes this an integral part of the flyagonal, is having that positive vega and some protection to the downside. If we look at this put diagonal, again, it's down here largely because if our market drops, we want that positive vega. If our market drops, volatility goes up. And look what makes money if our market goes down and volatility goes up. So that's why these two pair so extremely well together. They're almost self-adjusting to a certain point.
Okay, well, let's see if that really happens in real life. So I'm going to put one of these on based on the rules that he said, and then I'm going to take a look at it. The call butterfly, I don't really see any issues with that. You know, obviously you're going to make money if the market goes up into the butterfly and into that tent and the volatility comes down. I know the butterfly is going to do fine. Like, I'm not really worried about that part of the trade, to be honest. It's the diagonal that I really want to take a deeper dive and look at. Let's see if I can build that diagonal. So I'm going to use SPX. Okay, so these expire on the 8th. So I got to go back 8 days from that day. All right, so here, this is about the time when he put this trade on. So we had the August 8th with 8 days. And then we'll look at the August, the 18-day one, which is right here, which is August 18th. So this is the same time frame that he has on his. So I just want to rebuild exactly what he did. So on August 8th, at this time frame where the market was about here, he put on -2 at the 63.20, 63.20, -2, and then he went all the way to the 6,300 plus 2, that's the 18. That's 300 plus 2. Okay, so let's look at that. So what that does, let's bring this in here. This is just the diagonal. I'm not worried about the upside. What are the deltas? So basically, he's going short at the 30 delta and long at about the 30.5 delta. So let me just put that in there. Forget the 3% down. Let's go with the short put at -30 delta and the long put, which is 1618, at -30.5 delta. That way we can build this in other time frames, right? So if we can build this in other time frames, that will help us see how it reacts. Okay, so this is pretty much the trade. Let me commit this. What I'm going to do is create an account here. So let's go to settings, create new account. I'm going to call it the Flyagonal account. Flyagonal. And I don't know, usually this is around maybe $1.18. Let's commit this trade. Let's just call it the Flyagonal. You can see it's put on for a debit, but I'm going to put it in the right account called Flyagonal. Did I write that right? Yeah. Okay. So now we're hanging out here. Let's get into that account so we can see the trade. All right. So here's where we're living. Now, you've got this positive vega here, but here's where I'm kind of a little bit skeptical. A couple of things. So if you adjust the vol, yes, look what happens. You're going to make money, but you have to understand when you adjust the vol here in the 8 DTE and you adjust it in the 18 DTE, by using the vol adjustment, you are adjusting both of those vols equally, and that is not what happens in reality. What happens in reality is typically something called weighted vega, which means when volatility increases, it typically increases more in the nearer, closer DTEs. So for example, possibly, we'll take a look at this. This 8 DTE is closer, so therefore the volatility will increase more than it will in the 18. So let's take a look. So the 18 DTE has 11.74% vol, and the 8 has 12.36. Okay, let's go to the next day. Let's see what happens. Okay, so one day later, we had a significant drop where we're down 111 points, so the volatility increased. The VIX went from, let's go back one day, the VIX went from 1593 to 2117. Okay, so this thing didn't seem like it didn't do its job. Now, why? Well, remember, the vol was around 12 and it went to around 18. Let's see what it did over here. Remember, it was 11. And this went from 11 to about 16. Now, this trade leg P&L made $77. And this was down $83. So this leg, because it's closer, it's a shorter DTE, was more highly affected by the rise in volatility. And you can see that this leg has a more of a drawdown compared to this leg. This leg's up 77, and this one drew down 83. But if you increase the vol using this, you kind of get even weighted. You get an evenly distributed volatility amongst these two legs. But in reality, it's not an evenly weighted vega situation. Vega affects and rises more in the nearer DTE compared to the further DTE. And you can see what happened here. You're going to be down significantly. Well, this was just too much of a move for this diagonal to handle. And also, the volatility did not necessarily widen out this tent, right? Let's see what it was in the beginning. You can see where our break even was. So in the beginning, the break even was around 63.43. And let's see if it widened out the tent a little bit when the volatility went. And then it's around 62.76. So it did widen out the tent like it was supposed to, but probably not as much as what was originally, forecasted. So I wanted to make that a point that weighted vega and the differences between these two expiration cycles can make this trade not exactly the way Steve explained it, because he explained it in such a symmetrical way, using volatility as a symmetrical move in volatility, but that never happens because of weighted vega. Let's put this on in a crash kind of scenario. Let's just put it on in August of 2024. See, because one of the other things I always like to point out is, yeah, that's a great trade. And if you're looking for a trade that's going to, make money most of the time, and then that's fine. But you also want to know, what does it do in all market environments? And I don't think this trade would do very well in a crash, even though technically you're long vega, right? So let's go back to August of 2024. Let's just put it on here where the vol was relatively tame. The VIX is here. We're coming into that kind of spike. So let's see if I can get the 8 and 16. So the 8, and then we're going to go into the delta of around minus 30. Yeah, 30, 42, and 22. Let's see if I can get something a little. Okay, right here, right when it's 30. So let's go with minus 2 here, and then we'll go out to the 16. Let's go 20 points lower. So what did we do? We have the 54.60. So we'll go to the 54.40. And we'll go long 2. Let's see if that builds that thing the way it should. Yeah, see, he went 20 points lower. He started at, he doesn't have his deltas in there, but I kind of calculated them. So we'll just go 20 points lower. So that's pretty much the structure that he built. Let's commit that. Flyagonal. right, and what happened the next day? Well, we're up pretty good that day. VIX, okay, we're down pretty good. You're only down 60, so you're not getting a lot of protection. I mean, you're only down 60 here, which is, it's a bigger move. It's a bigger move than normal probably. So as long as you have like these normal moves, you're going to be good because you can see you're going to be in here. But look at what could happen. Let's go to the next day, August 2nd. We're not even in the crash. This is just that Friday before. And you're getting pretty smashed here. And the market hasn't, I mean, it's down for sure, but it's not like huge. But the VIX did spike. So the volatility here is not protecting, like this volatility thing is not protecting as much as you might have thought by watching that video. Obviously, the next day is going to be pretty bad, but you can just see, pretty decent down move. You're not getting that protection that you might think. Let's go into August 5th. Obviously, it's going to get smashed. Yeah. So you're down about $4,500. So you're down pretty heavy, obviously. And this thing didn't protect you. No, even the T+0 line, even over here by the 10, didn't even handle this. So just beware. This flyagonal thing, the downside part, this diagonal, it's pretty cool. How the volatility kind of protects you, but you better be in a normal move, in a normal range and stuff like that. But if you get the out of the ordinary, a little bit of out of the ordinary move, where August 2nd, of 2024, or some type of grind down or something like that, you're not going to get kind of the protection that you might think you're going to get by watching that video. So I just want to kind of make that point as to this diagonal and how it protects you or it doesn't protect you. In fact, we can take this through a grind down. Let's go through 2022 and put this thing on, and we'll say January 3rd. And let's go to the 8 and 16. Let's see if they're available. We got the 9 and maybe the 9 and 18. Okay, so we'll go with 9 and 18. So we'll go with the 9 here. We'll go with about 30 delta. Let's see, 29.15. Let's see if I can get that. 29.83, close enough. So we'll go -2 here, and then about 20 points lower. So let's go to 4,700 on the 18. 4,700, go +2, and we'll just call this the flyagonal. It's not really a flyagonal, it's just part of it, but I just want to see how it does. Okay, so now we're going to kind of grind down. Let's see what happens. See what kind of protection we get with it. Okay, it's looking good. The market's not grinding down yet. It's looking good. Does well here. I just don't like this, but looks like the grind down is doing fine. Okay, so but you are limited, even in the grind down. Let's see how much this market's grinded down. It hasn't gone down too much. 47.86 down to 47. So you get a 100-point move. This thing is not going to protect you. You can see that already. So maybe we continue to grind down here. Okay, so it didn't move at all too much, right? Yeah, kind of didn't move at all. Let's see what happens the next day. Okay, so, even the grind down market, so we went from 47.66 to 4,600, so about 150 points-ish, and you're hurting pretty bad. So you just got to be aware it's not necessarily a grind down or a crash. It's more of a point move. You move down 100 points, you're going to be hanging on by a thread, and then once you're down 150 points or more, the diagonal part of this is not going to make you money. Now, also that butterfly probably is going to be hurting too. So you're going to have a loss here and probably on that butterfly too with that flyagonal. I have to look at that, but I'm just kind of want to just show you this half of it, how much protection this diagonal actually gives you. And the reason why, again, look at, you're down $98 here. Of course, he said he would have been out by now, right? But so I have to say that, but you're down 80 here and you're down 98 here. So again, the near expiration, you're not going to get this even distribution when you do this, when you increase the vol on a model. It doesn't work that way. The nearer expiration typically will, because of weighted vega, increase in volatility much higher than the ones that are further out in DTE. So the one that's further out in DTE, that's the one you want to increase in this flyagonal thing, in this diagonal. So in the diagonal, you want this particular one that's 18 days, this particular strike, you want this one to increase in volatility faster than this one. But just the opposite happens. This one increases in volatility faster than the other one. So you have that offsetting situation where it's not giving you this model. Okay, so I just want to make you aware of that. All right, so that's what I have to say about the diagonal portion of the flyagonal and what kind of protection it gives you or doesn't give you, based on the video there that based on this video here, which is the flyagonal option strategy, 96% win rate, $24,000 in 2 months. The last 2 months have been pretty bullish, so yes, that makes sense. But if we have a grind down or any kind of down move, or we're down over 100 points, this particular structure here isn't really going to protect you very well. Now, that doesn't happen very often, but I just want to tell you, take a look at, always look at the downsides and the drawdowns of a particular trade. The first thing you want to do is when you see a trade is you want to break it. If you can break it and you're not comfortable with the break, then I wouldn't trade it. But so if you see a trade like this, try to break it first. And if you can break it, then you can understand it better. So that's why I made this video. Now, also, I want to talk a little bit about how you can learn more in options, and one way that you can learn from me, and you can do it for free. So I'm going to talk about that a little bit next. If you've ever made a few good trades only to give it all back a week later, then this right here is the moment to break that cycle. Free for a limited time, I'd like to personally invite you to the All Market Profits Safe Wheel Masterclass. This is my 5-day program where I help you install a real rules-based trading strategy, one that's already outperforming the S&P by over 10% in the first quarter of 2025, and it only takes 15 minutes a week to implement. Click the link in the description to get the course, the exact rules, and the trading flow chart, all 100% free. You'll get everything you need to trade this strategy with confidence, even if you're brand new to trading, even if you've tried other systems that didn't work, even if you think trading success is out of reach. Here's what you get: the full 5-day masterclass. I walk you step by step through the exact safe wheel structure I trade myself, designed for clarity, confidence, and consistency in any market. Click the link in the description for instant access. Every week, I go live with our community for coaching, trade reviews, and Q&A. And these sessions happen every Monday. And yes, I even share my screen and show my real trades. And this is the next best thing to having me sit right next to you while you trade. Click the link in the description to download the full set of rules and get started. If you're ready to stop guessing, if you want a trade plan that works in bull markets, bear markets, and even crashes, click the link in the description and you'll get instant access to your private quick start area where I'll walk you through each part of the strategy in short, clear lessons. Each video is under 20 minutes. You don't need to overthink this. If you can follow Google Maps, you can follow this strategy, and it's 100% free for a limited time. Click the link in the description and I'll send you everything you need to get started. So let's build your edge together.